Hello friends, you're watching Tax Dosti videos. I am your tax host and tax host, Advocate Anthony Williams. We are discussing this week how to prepare your business tax return. And in front of you, you have the Income Tax Ordinance 2001, the tax law of Pakistan. And basically, the most important sections regarding the legal charge of tax on income are section 4 to 8, but in regards to calculation of taxable income, that is tax accounting, we will be discussing tax accounting sections and principles in this video. And the main point is that basically income tax law is also is just like financial accounting rules. These are rules which help you to calculate profit, but taxable profit, profit on which you have to pay tax. They are separate from financial accounting rules in the way that financial accounting rules help you, or accounting standards help you to understand or calculate the net profit according to standards like international financial accounting standards. But they are similar, that financial accounting and tax accounting are similar because they help you to calculate profit. Let's go to our section. And in Pakistani tax law, the main focus of tax rules are for income from business, and we will see that though other heads of income like salary and capital gain also have their rules, but for income from business there are detailed rules given which are called tax accounting, and through them you have to calculate the taxable profit, which is different from net profit calculated as per international financial reporting standards or generally accepted accounting principles or any accounting framework. So let's start. This is tax accounting, and I will repeat that basically tax law is also a kind of financial. It uses financial information to calculate taxable income and make tax compliance. Financial accounting also uses financial information, but the purpose is to report profit to shareholders and make do financial reporting, whereas tax accounting helps you to do tax compliance. So let's start. Section 32 says method of accounting. So subsection 1 says that a person's income, and there are 5 heads of income in income tax law: salary, capital gain, income from business, income from rental income, and income from other sources. So can be computed with the method of accounting regularly employed by such person, meaning that any person, salaried person or getting rental income, the the way the method he or she uses to calculate their profits or their income will be method acceptable for tax law. But subsection 2 says that a company shall account for income chargeable to under the head income from business on accrual basis. So a company has, though every person, he can be a sole proprietor or a property owner or an employee, have been given leverage to employ the regular way of accounting, that could be cash or accrual, but companies are bound that their income from business will be based on accrual basis, while other person may account for income on cash or accrual basis. Cash basis and will be cash basis and accrual basis will be defined going forward. The board has the power to allow any person to change, if they sole proprietor or if they are partnership business, they can also choose to use the accrual basis of accounting, or if they are using accrual they could change it to cash. So in this way the law is flexible, that the kind of accounting you are doing they are allowing, but it should be consistent. And for companies, the income from business should be on accrual basis. Then a person applying to the commissioner order approve such, the commissioner may approve if he is satisfied that the person is not hiding any income or making any false claim, so he will allow. And if a person's method of accounting has changed, subsection 5, so if he has already taken in account some income or some deductions, he will not be able to take them again, so there will be no double accounting. Cash basis means when a person, and in person we have individuals, we have partnership, and we also have companies. But here, when we are talking about cash basis, so cash basis is normally allowed to individuals, sole proprietors, and partnership business. A person accounting for income chargeable to tax under the head income from business on cash basis shall derive income when it is received or shall incur expenditure when it is paid. Just like small businesses definitely don't have a elaborate system of accounting, so whenever they buy something they record it, and when they sell it on the spot they get the money, and there is no credit or creditors or liabilities. So cash basis of accounting is allowed to all those persons doing business. Accrual basis of accounting is when it is due to the person and shall incur expense which is payable, meaning that even if they do not pay immediately, they do not get cash for their sales, they make credit sales, or if they do not immediately pay for their expenditures, still they have to record it in that tax year in which it was incurred. So accrual basis is a must for companies making their accounts for income from business. Then an amount shall be due to person when the person becomes entitled to it. This is some further clarification is when does an amount become, because in tax making compliance with tax, some people try to delay the receipts and show the income expenses before, so just to make their profit less or to show income. So the law is giving in detail the reasons where what is considered as due and not due, and it is also discussing in this section, this is accrual based accounting subsection 3. It is also discussing what becomes payable, what liability, when does a liability become payable, meaning when are you liable to pay for something. It is definitely when you consume something, some goods or services. Similarly, when a person has allowed deduction for any expenditure deriving income and the person has not paid the liability or part of the liability within 3 years, at the end of the year, then that amount will be reversed. Now, as I was telling you, this is subsection 5 is a great example where the normally in tax law, in financial accounting, this doesn't happen. Even if a liability has been unpaid for 3 years, 4 years, it still remains on your balance sheet, and the corresponding expense is booked in the relevant year. But what many people used to do is add fictitious expenses to their against their incomes, so as to reduce profits, so as to reduce the amount of tax payable. So this section is different. This section is tax accounting, and such thing is not available in financial accounting, because the liability is carried till perpetuity. But here people misuse that in the sense that they create fictitious expenses and corresponding fictitious liabilities which remain unpaid for many years. So to discourage that and to catch such people who want to evade taxes or avoid taxes, this section has been given in. And there is an opposite situation where a liability has been identified but is to be quantified. So section 5A deals with such trading liabilities. And you have to understand that the problem with tax law is that you have to give in writing every such situation. So sections keep on becoming 5A, 5B, and keep on splitting. Achha, subsection 6 says that any unpaid liability, if it eventually gets paid, this relates to section 5, and there is possibility that a business genuinely has booked an expense and the creditor has not taken the payment even after 3 years, but eventually after 5 years he takes payment. So that expense will be then allowed in the fifth year or whenever that liability is paid. Going forward, especially for manufacturing and trading businesses, these are the rules on how stock will be calculated. That is, income from business, the cost of stock disposed by the person shall be computed by opening value of stock plus cost of stock in trade acquired during the year minus closing stock, which is actually a correct financial accounting rule also. But tax law, by giving this in tax law, there can be no other way. Now the income from business in your tax return, you have to apply the same rule, and the closing value of the stock will be calculated. Opening value will be calculated according to the closing value of the last year's stock, meaning the closing stock of last year becomes the opening stock with the same value, or if you have started the business during the year, the fair market value or the cost price at which you purchased the stock becomes the opening stock. And then there are some other details, and then there are cost system, absorption cost system, average method, direct labor cost, direct first in first out method, prime cost, stock in trade, variable. The purpose of giving all of these definitions and these rules here is that when you calculate your stock, be a trader or a manufacturer, for example, if you're a manufacturer, absorption cost means that you take in all the direct material cost or the direct labor cost and a portion of the factory overhead. So you can use this method, you can use the average method, you can use the direct labor cost method, and then when you sell your goods, the amount, the value you book for your profit can be based, should be based on first in first out method, excuse me. And then the last rule that is given in section 36 is long term contracts. And long term contract means that basically these are businesses which are construction businesses, or even maybe a factory may be constructed from scratch. So if you are doing such contracts, then your accounting will be according to accrual basis and will be computed on the accounting rules of long-term contract basis on the percentage of completion method. Meaning every year you will book the revenue and the expenses according to the percentage of completion of the project. Meaning if the project is for 3 years and in the first year you have completed 20% of the project construction, then you will book 20% of the revenue and 20% of the expenses, and the remaining will either be assets or liabilities, and so you will move on. And this has been given here. If it was not given here, then the above rules would have applied to long-term contracts, which would have made a lot of problem, because this is a good way for people to undershow their profits. And this is also, if the long-term contracts and these rules were not given, it was they would have been misused by FBR to harass genuine taxpayers who have kept regular books but were not given this option. So these sections are the tax principles, tax rules under which you calculate income from business, the taxable income from business, which is different from the financial accounting income that you calculate according to financial accounting rules. So, whenever you file your business tax return in Pakistan, and these rules are common, definitely every jurisdiction will have similar rules in UAE, US, etc. So, whenever you file your business tax return, these rules should be kept in mind while doing your stock, your sales, your direct expenses, and in this way you will be able to arrive at correctly at the taxable income, starting from your audited financial income, which will be your audited accounts, because it is must for sole proprietor, for partnership, and for businesses to have audited accounts. They can have cash system, but if they are filing their income from business, they have to have their audited accounts. And especially for tax year 2025, which is right now, a penalty of 1 million has been prescribed for all those partnership businesses and companies that do not file their audited financial statements along with their tax returns. So be very careful and please comply with this. You're watching Tax Dosti videos. I'm your tax host and tax host, and let's meet in the next video. Thank you very much.